In this tutorial, we're going to be looking at specific deductions. Now, you may recall when we were talking about income a few weeks back that there's two broad types of income, which we call ordinary income under 6-5 of the Income Tax Act 97, and things that aren't income under ordinary concepts that are only counted as being income under 6-5, what we call statutory income, basically because Parliament said so. Now, the exact same thing applies for deductions. The default rule for deductions is set out in 8-1. However, there are some very specific sections involving deductions which are also given to a taxpayer, or in some situations more carefully explained in terms of how they can be deducted, and those can be incorporated into the taxpayer's return under 8-5. And so some examples of this are such as the ones posed in front of us now. Here, for example, the taxpayer is asking, in the first question, whether or not he can deduct $500 that he gives to the hospital while he's being treated, as well as $500 to each of his carers, to the nurses. And of course, we know from our earlier experience with deductions is that by default, the answer would just simply be no. These are essentially private in nature, and as such, are disallowed under the negative limbs in 8-1. However, there may be some other sections in the Tax Act which we may be able to claw back some form of deduction using. Now, the second question we have here is to do with prepaid expenses. That quite a common situation in business where an entity would pay a sum of money and the particular length of service is going to go beyond the end of the tax year. This is quite a familiar thing for the accounting students amongst us, and it's very carefully mapped out by Parliament how the taxpayer goes about making deductions for these sorts of prepayments. And so looking at the first question, again, 8-1 says, look, you can't deduct things of a private and personal nature, and there has to be some sort of nexus to an income earning activity. And here, this situation has neither. However, 8-5 says that despite the fact you can't normally deduct gifts that you give, gifts to hospitals can actually be deductible under section 30-15 and 30-20. And really this is for public policy reasons, that institutions that are benevolent for humankind, Parliament deems it wise to be able to give taxpayers some form of relief through funding these types of institutions. However, there's a catch here in that the Commissioner can disallow gifts made in the situation when they're not genuine, when they're not bona fide gifts to these sorts of institutions. And also note that only applies to the institution itself, not to the carers or employees of those places. And so in this case, the gift to the hospital can be a tax deduction. However, gifts to the nurses will not be. Now, for this second question, where $100,000 is paid as a lump sum. Now, this kind of unfortunately is mapped out, but it's mapped out in the old legislation. So it's in the 1936 Act between sections. Bit of a mouthful. It's 82 capital K, capital Z, capital L, through to section 82 capital K, capital Z, capital O. And in 82KZL, basically just says, look, advanced expenditure needs to be amortized, in other words, deducted over the entire life of the benefit, or if the benefit's over 10 years, just up to 10 years. So at first glance, this $100,000 expenditure, it would be amortized over the next 3 years. However, there are some exceptions to that. Basically, advanced expenditure, in other words, expenses prepaid, can be deducted in the current tax year if either it's less than $1,000 or it's to pay or to satisfy a judgment of the court, or it's to pay wages or salaries, or, this is tricky, it's a non-business prepayment by an individual, as a natural person, where the service period itself is 12 months or less, and it just happens to fall over the end of the tax year. If it's over 12 months, then you can't. It's got to be amortized across both periods. There's also some exceptions for small business entities, and again, we'll return to these later in the subject, but just note that small business entities defined by its annual turnover, which interestingly only includes ordinary income, not statutory income. And if that's up to $2 million, then that business can fall under that particular category. And so here, we're not really given enough information. It's possible that the taxpayer could be an eligible small business entity. We don't really know. However, the benefit goes for more than 12 months, and it's greater than $1,000, and it is not to do with a court order or for wages or salaries. And therefore, from the information we've got, this would have to be apportioned over the years in which it falls, basically based on the number of days. So, for example, if you paid the expense halfway through the current tax year, and it was to go 3 years from that date, you would deduct the equivalent of half of 1 year's. So essentially 1/6 of the amount, 1/6 of $100,000 in the first year, 1/3 in each of the 2 years after that, and the final amount in the 4th year. The next question is an interesting one. It's also a very popular style of question to be examined on, and it's to do with repairs. And so here in the problem that we're faced with, the owner of a hall needs to repair the ceiling, seems to be damaged, and when doing this repair, they decide to spend just a little bit more money to make it look a little bit better, and also to actually improve the acoustics of the hall as well. And so the core issue here is whether or not that's fundamentally, is that an expense, or is it going to be some form of capital works? And the owner of the hall, in almost all situations, is really wanting these things to be deemed an expense in the current period and not capital in nature. The commissioner, of course, takes quite a different path. And so when looking at the situations where a building's been repaired or improved, it's basically about characterizing it one way or the other, because a repair is just a simple deductible expense under 25-10, whereas an improvement isn't. It's capital in nature and needs to be amortized, which we'll get to in a second. Now, the rules for doing this, they're not hard and fast. There's a bit of argument either way with these things, but the general sort of starting point is that a repair is putting an item back to how it was without fundamentally altering, and particularly without improving the particular item that we're looking at. It's also important to note that that a repair can only be some form of partial fix or partial restoration of the greater thing, the greater item. It can't substantially replace the whole thing. And that kind of makes sense. Replacing an entire asset is clearly a capital transaction in itself. And so in Lindsay and in Western Suburbs Cinema, the courts looked at this and they used this phrase, whether the item or thing being replaced is separately identifiable as a principal item of capital equipment. And we're really looking at the substance. Is this a big chunk of the thing that's being repaired or improved? And so turning to the task at hand, the taxpayer has expended more money, and they've made, through using different materials, they've made the ceiling better. Now, this is a bit of a quirky policy situation, because if the end result is in absolute terms better, and which it appears to be in this case, both the aesthetics and the acoustics have both been enhanced, it's very, very hard to turn around and argue that, well, oh no, no, this is an improvement. This is a repair and not an improvement. Um, it certainly adds in some way to the value of the um, of the dance hall itself, above and beyond where it originally was. It really does make the thing um, functionally better in absolute terms. Now, if there was some sort of defect that came up as a result, for example, the new ceiling perhaps couldn't have appropriate lights attached to it, and so the hall was much dimmer as a result, something of that nature, then the taxpayer would have a far stronger um, position than they have here in terms of arguing whether it was, it was a repair as opposed to being an improvement. Here, however, it's a very, very difficult position to argue from, where you've made things absolutely better. And it's really not helped by the fact that quite a lot more money was spent on it for this particular desired result, to do it properly. And so there's a few things to note here when answering a problem like this. First of all, that assuming that this is an improvement, it's going to form part of cost base, which we'll get to when we talk about capital gains. Just make note of that. And because it's improvement to a building, it's not a depreciating item or asset under 40-45. It's a structural improvement. These have their own specific rules for deducting, and in this case it's 2.5% over 40 years. So it's a much, much smaller deduction that you can make for depreciating that, and that's in 43-25. The next bit we're going to look at is depreciation. And this is a little bit involved, and for better or for worse, it also forms a large part of professional practice. And so there's some multiple factors and things we need to look at here. We're going to go through the formulas for depreciation. We're also going to look at the allowances for private use in situations where a person uses something for their own purposes and not for business purposes for some fraction of the year. We've also then got to look at balancing adjustments when an asset which has started to be depreciated is then sold, either for more or for less than what the book value is. We're going to look at some CGT implications. I think the point to make here is that doing depreciation and topics in tax law that require a lot of calculations and steps and processes really requires a lot of practice. It's wholeheartedly recommended to listeners that you do go away and just try to recreate or replicate this style of problem or even this exact tutorial yourself by hand. You'll find the process of doing that absolutely invaluable when it comes to assessment. So when we're looking at a problem like this, it's helpful to start by explaining all the underlying rules and principles. And in the case of depreciation, it's in Division 40. Now, it's also extremely helpful both in terms of demonstrating to the market, to the examiner, and also to really stop yourself from making sometimes silly errors, to very clearly take the formula from the particular section in the ITAA and express it, actually map it out and use the words, the tax words, when doing so. So here, for example, write out your depreciation deduction for a particular year is equal to the base value of the asset multiplied by the number of days it's held in the tax year, divided by 360, times 200%, or basically times 2, multiplied also by the asset's effective life. And it's helpful to explain also to the person who's both market and for your own assistance to go through each of the terms that you've used, really to make things as clear as possible prior to actually starting to use numbers, essentially plopping the numbers into that formula and spitting out a result at the end. And so there's a couple of gotchas with depreciation, and one of them, a really, really important one that students quite commonly sort of fail in and make the mistake in, and that's the base value figure. Now, base value figure for the first tax year that you're dealing with is simply the value that you're starting with for your asset. You know, usually you say this is the in a problem that we'll give you, it'll be the cost. And those familiar with accounting, the cost also includes the cost of installation and things that are have been incurred at the time to really to create the particular asset that we're wanting to depreciate. And this kind of makes sense because the whole purpose of depreciation, both in accounting and how it's expressed in the tax law, is this idea of spreading the cost of the item out over multiple periods. In the case of deductions, it's writing off and being able to claim that as a tax deduction in subsequent tax years as a result of the asset essentially starting to lose value and go through its useful life. And so I guess the challenge here is just to remember when you've got an asset which is partially used for income earning purposes and partially for private purposes, that the asset value is going to include 100% in terms of the amount that it's going to reduce. In other words, the base value for the next tax year. However, the actual deduction you get in any given year is only going to be the fraction that you use it for income earning purposes. So here, in this problem question, we're using the asset for 90%, and so you have to note that when we're determining the deduction for the tax year, which in the first year is $10,000, that's really only a $9,000 deduction in terms of it said that it'll actually go into your tax return. The extra $1,000, the reduction for private use, though, still counts towards reducing the base value for the next tax year. And so as you can see when going through the slide, the opening value in tax year 2 is this adjusted opening value of $90,000 in this case. And another thing I think is important to express here is that this subject is still fundamentally a law subject. We want to see you guys demonstrating to us that you know the underlying rules and principles and the process of going about doing it. We're not as concerned about necessarily minor arithmetic errors. And certainly in something like a depreciation question, it's not uncommon for a minor error or typo somewhere at the top of a problem to have flow-on effects. Now, there's something of a challenge or a problem here. If an asset is disposed of before its value has been reduced to zero, this is a very common occurrence. So, for example, you have an asset such as a piece of plant or a vehicle of some sort. It has an adjusted value which changes each year depending on how much depreciation has been deducted plus this non-taxable use. And so the book value reduces over time. That's pretty logical. Now, the thing is that book value, I mean, it's kind of a made-up number, really. If you need to sell an asset at a particular point in time, then it's very unlikely that any business or individual is going to sell it for exactly what the book value is. And so the Income Tax Act takes this into account. And when disposing of an asset, and the value we refer to here as the termination value, which again includes the cost of disposal as well. If that is more, in other words, we sell the asset which in our books is significantly reduced and we're selling it for more than what we listed in the books as, then that gap, that difference, that balancing adjustment is going to mean we're going to have to include that as income. If, as is often the case, we sell it for less than what's in the books, then that's going to be an allowable deduction. And in each of these cases, it's Division 40, Section 285 that sets this out. And when answering for us asking and you guys answering these sorts of questions, the tricky part is taking into account the private use. Again, it's a common situation where a person uses an asset largely for business and reasons and partially for private use. And so these things have to be taken into account through a series of formulas. So the first of these is what we call a positive balancing adjustment. On the first line here, it's referring at the end to where the termination value is greater than the adjusted value. In other words, the value we had in our accounts. So in this particular problem, we sold the particular asset for $110,000. Now, when we are looking at this total decline in value, that total decline includes both the amount we've deducted plus the private use percentage. So in this situation, the asset cost $100,000 and had $14,537 worth of decline up to that point. So when we're calculating what the balancing adjustment is, that's pretty straightforward. Look, determine what it is in the books at that particular time and just take that amount away from the termination value. In other words, what we received for it. And so here, that's $27,537. Now, the next step is to try and determine what the amount we're going to have to reduce this balancing adjustment amount by for non-taxable use. And there is a formula. It's in 40-290 subsection 2. And basically, it's the amount that this particular adjustment is reduced by is the sum of the reductions times the balancing adjustment amount divided by the total decline. And I guess the key thing to note here is that we don't really care what the percentages have been. It's really the amount that has been sort of entered in terms of private use. In this case, $1,227. And at the end of sort of putting the numbers into this formula, it'll spit out the amount of the balancing adjustment that we add to our income. And that kind of makes sense. Look, we've had a few deductions in the past. We've depreciated this particular asset, and then we've sold it for more than what its book value is. That gap has got to be included in our income for the year. Now, another thing that you need to be aware of, and it's quite easy to forget when having this style of question, and it's quite logical when I say it, is that, well, if this particular asset was purchased for $100,000 but sold for $110,000, that means that there's been a capital gain. And so as a result, this, notwithstanding that there are balancing adjustment calculations again, that are added under Division 40, there are also CGT considerations as well. And so here, there's a specific section, 104-240, and there's a formula in there as well. Basically, the gain for the year is the termination value less the cost times the sum of the reductions that you've had divided by total decline. And again, simply putting the figures that we've already had from earlier calculations into that means that capital gain, which is much, much, much smaller, we'll note, than what it would have been if this was just a straight capital gain and we weren't doing a balancing adjustment. There you would just it would straight up be 110 minus 100, and you would just have a straight $10,000 capital gain. But because there's a balancing adjustment already in there that's been added back into income, then the amount's much, much smaller. The next thing to look at is really just the flip side of the positive adjustments, which is the negative adjustment. That's where you've gone to sell your asset. In other words, the termination value is less than the adjusted value, than what we had it in the books at that particular time. And you should note here that these formulas and these steps are just extremely similar to the positive balancing adjustment. They've just, some of them are just reversed. Having another adjustable value where less the termination value, and that's just to avoid negative numbers. The formula is exactly the same as with a positive balancing adjustment. Just make note at the end, very, very importantly, to note that where you've got a negative balancing adjustment, it's going to be an allowable deduction. And so here, the adjustable value just before the event occurred is going to be identical to the earlier, the positive balancing adjustment, but the balancing adjustment amount, the BAA, is going to be different. I mean, basically, in the previous one, it was 110 less, 85,463, and here, we're selling it for $80,000, and so this the BAA is going to be $5,463. And then, once we've got that amount, we can just plug that into the exact same formula to determine the amount that we've reduced this by for non-taxable use. And so at the end, you take that $5,463, which is the BAA, the balancing adjustment amount, and take away this this non-taxable use reduction of 461 to get an allowable deduction of $5,000.